Hello and namaskar everyone, I'm Prashant and today I will be discussing about fundamental analysis, how you can analyze a company or a stock before you invest in that stock. Because I've seen many people who start investing in a stock without knowing anything about that company. They just heard about that company from any news channel or from a YouTube channel, or they have read somewhere in a blog or on Twitter or on any social media platform, and they start investing in a company without having any knowledge about it and end up losing money. And when they lose money in stock market, they don't come back to market thinking that stock market is not a good place to invest. And they then start investing in banks, earning only about 4 to 5% interest, which is not how you should approach stock market. If you have no knowledge about stock market, how you can invest in stock market, then you can start investing through mutual funds. If you do not want to learn anything about investing, then you can start investing through mutual funds. However, if you want to learn how you can analyze a stock, how you can invest in a stock to be able to earn profit, to be able to earn more return than what you are earning in banks, then yes, you can definitely watch this video series wherein I will be discussing everything from analyzing to selecting stocks and from selecting to investing in the stocks at the right time, at the right moment, and exiting, earning profit from those stocks. So without any further ado, let's begin. So here is a short introduction about myself. I'm Prashant Jain, actively investing and trading in stock market since 2012. And stock market has given me freedom to do whatever I want to do in my life. And I'm also traveling along with trading. I've also created a price action trading course with which you would be able to trade, day trade or intraday trade and earn good profits, and then you can invest those profits into investing in stocks so that you will earn even more profit. That is the cycle. Money makes money. You should have money working for you, not you are working for money. So let us begin with the episode 1 of fundamental analysis of stock market. The first step before investing in a company is to analyze financial health of a company, because you are investing in a company for, you're not investing in a company for 1 or 2 days. You are investing in a company for a longer time period, maybe 5 or 10 years or even more. So we want to know whether this company will be able to survive in the longer time, whether the financial condition of this company is good. There are chances that company is performing good today because of favorable conditions, because of favorable economic conditions. But what happens if the conditions are not favorable? Will the company be still able to perform good in future? Which is why we analyze balance sheet of a company. Now, what balance sheet tells us? It tells us how healthy this company is, how healthy this company financially is, whether it is earning more profit, whether it has less debts, what are the bank balance of a company, all those sort of very basic and fundamental information you will get when you will read a balance sheet. Now, there are several other information which you will get when you are analyzing a balance sheet, when you are reading a balance sheet, but you don't need to read, or you don't need to analyze all of those things, and you don't even need to be from a financial background. I'll tell you what exactly you should know when you are reading a balance sheet. So there are only 4 important things which you should analyze when you are reading a balance sheet. So let us just open a balance sheet of a company so I can explain you what all are those 4 things which you should keep in mind, which you should analyze when you are reading a balance sheet of a company. All right, so we have a balance sheet of Reliance Industries, as you can see here. This is a balance sheet of Reliance Industries. So this is how a balance sheet of a company looks like. It has several information. It has so many information, but we don't need to analyze all of those, and we don't need to know all of those information. What does those information means anyhow? So what do we need is, we need to know and we need to analyze this, which is called total share capital. Now, what does this total share capital means? It means how much is the capital of a company? What is the property? What is the worth of the property? What is the worth? What is the capital worth of a company? And it should increase year after year. So when we are analyzing, we want total share capital of a company we are analyzing should be increasing year after year, which in this case is increasing from 3,240 crores to 3,251 crores to 6,335 crores and so on. So it is increasing which is a good sign when we are analyzing a company. Second, we would be analyzing reserves of a company. What is reserves? Reserves are the bank balance of a company. How much money this company has reserved, which can be used in emergency situations, which can be used towards paying off debts, which can be used towards making a new factory, building a new factory, new company, new office, employ more people, which will be producing more products, which will create more selling, which will earn more profit, and in turn, it will give us more. It will also help us earn more if we have invested in that stock. So reserves should also be increasing, which is in this case also increasing year after year. Now, after reserves, the next important thing which we should analyze is total debts or debts of a company. What is debts? Debts are the loans which company has taken to run their own company. If you have more debts, then what will happen? Let us say I have a profit, I've earned a profit of 100, but my debts are 80. Then what is my net profit? Net profit is only 20. Out of that net profit of 20, I will have to pay salary, I will have to pay bills, I will have to pay taxes. Will I be able to pay any dividends? Probably not. Or if yes, then it will be very less dividend, which is again one more source of income for investors. So we earn when the company grows, when the stock price goes up, we earn money, and we also earn dividends from the company. When the company earns profit, they give dividends. However, if the debt is more, then they would not be able to pay off more dividends. So this is not a good sign if a debt is more. The best company would have zero debt or very minimal debt. Good company or average company will have debts less than their reserves, which in this case Reliance has less debts than their reserves. So it is an average company in terms of debts. This is not the only way to analyze it. So in terms of debt, it is an average. But as we are analyzing the balance sheet of a company, it says that total share capital is increasing, which is a good sign. Reserves are also increasing, which is also a good sign. Total debt is increasing, but it is less than reserves, so it is also a good sign. Now, the fourth thing which we need to analyze when we are analyzing a company, about three things which I have told you, they are the fundamentals. Book value is an add-on. What book value means? Book value is a difference between the assets and liabilities. For example, I have an asset of 100. What are my assets? My assets can be properties, factories, offices, all of those are my assets. And my liabilities are, for an example, it is 50. So what are my liabilities? Liabilities can be taxes, liabilities can be debts. So my assets are 100, my liability is 50. What is the book value? Book value is 50. And if the stock of my company is trading at 20, however, my book value is 50, which means the company is trading below its book value, which is again a good sign. Because as Warren Buffett once said, market is always right. But when you see or when you find out that market is wrong, invest in that company. Because when market will correct their mistake, you will earn profit. But there could be more reasons why book value is less than the price of a stock. Reasons can be that the company future growth is not optimal, and the big investors are able to analyze that this company is not going to perform well in future, so they have taken profits. That is the reason why the price is declining. That's the reason why it has declined below its book value. So there can be several reasons why the book value is less, which we will be analyzing more when we will be analyzing other parts of fundamental analysis of a company. But as of now, book value is less than the price of a stock, which is also a good sign. So if we are analyzing Reliance Industries, as of now, company looks good to invest. So in the next part of this video, in the next episode of this video, we would be analyzing profit and loss statement of Reliance Industries again. And we will try to analyze whether this company, based on the profit and loss statement, is a good company to invest for a longer period of time. So till then, you can practice analyzing balance sheets of other companies, other stocks, which you want to. And you can tell me in comments what are the difficulties, if you're facing any difficulties, if you need to know more information. And let me know in the comments what all are the companies you find that are good to invest in for a longer period of time. And also make sure to like this video, share this video to your friends or to anybody you think it will be beneficial for them. And please subscribe to this video. And I'll see you in the next episode. Till then, peace.